It was around 2006-7 that the built environment of the Indian real estate was by and large of the opinion that the nature of the business is not conducive to getting listed on the stock exchange. There is a section of analysts who even today believe that the real estate companies should not get listed. They have their own reasons. The nature of the business is not like any other product. Here, the product is being sold even before it is ready. More importantly, nothing happens in a given quarter. So, the financial reporting of a given quarter does not truly reflect the resilience of a company or its true financial standing. Real estate stocks, hence, suffer from a perception bias more often than not. What precisely defines the intrinsic value of a real estate stock? Well, today I have two industry experts to discuss this. Welcome Mr. Abhishek Kapoor, CEO of Purvankara, and Mr. Sarad Mittal, CEO of Aranya Real Estate Fund Advisors. So, Sarad, my first question will be, what is the cost and benefit of a real estate company getting listed? Should they get listed or not?
So, Ravi, this is something which has been debated for really long. Whether it's a development company, given the structure of their business and the nature of their cash flows, are really meant to be get listed. Because in listed markets, one tends to have a shorter view, and things move quarter to quarter. But my view here is that as the sector is getting consolidated, we have a lesser number of developers who have now kind of moved significantly in their corporate governance, significantly move in professionalizing the entire senior management, and there is a need of capital. I think we are now getting into a cycle where I think it is favorable for developers, and I think this is a compelling opportunity for the investors as well. Unfortunately, the way things have played out in Indian real estate over the last 2 odd decades, people tend to have concerns on how this thing will play out. But I think now with the RERA being in place, consolidation taking place, and there is a requirement of equity. One of the key challenges in Indian real estate is absolutely lack of equity capital, and I would say developers should, but only developers who can fulfill the requirements which is expected out of a listed company should venture out there.
Abhishek, to what extent getting listed helps you in raising capital, and to what extent it helps you in your brand equity?
Ravi, see, if you look at, I agree with Sharad on the point of having the discipline. So according to me, getting listed brings a lot of discipline in a developer in many ways. And today, if you are a institutional capital, you're chasing institutional capital. The only way to chase institutional capital and for institutional capital to invest in you in a big way is if you are really high on governance and compliance, which comes naturally, generally speaking, to a listed player, because SEBI regulations, etc., disclosure norms, you're really following all those compliances, and therefore, as Sharad rightly said, only if you're professionalized, if you're capable of being listed and handling the compliances, is when you will get listed. That is one. Secondly, in the business also, it brings a lot of discipline, because share markets and stock markets expect growth, expect performance, and they expect quarter-on-quarter performance. So that brings in a very positive impact in the way you're looking at shareholder value as a business, in any business, because you come under public scrutiny in that sense, and it's reflecting in the your performance reflects in the market cap, right? So second thing. And the third, as far as brand is concerned, clearly we are seeing that today, if you look at all the listed players, they're commanding a premium as a brand in most of the projects that they're launching across the board, because the public perception is that, okay, there is so much value in the brand itself and it's visible. And then because our numbers get all published, right? When your numbers get published, the disclosure is so high that even people know, because, okay, this guy is a strong developer or not a strong developer, and where is he in the overall gamut of things, and where is he headed as a business. So all of those things helps build the brand, and of course bring in a lot of financial discipline and attract a lot of institutional capital. And then there is consequentially, you're also attracting land and landowners and customers.
Sharad, we all understand that historically real estate has suffered from a perception bias. Would you agree that realty stocks also suffer from a perception bias? Because if you look at the fundamentals, many of the company, for example, Purvankara also, the real intrinsic value of the stock is not reflected in its price point.
See, Ravi, the way I look at it, the collective investment fraternity or the investors is believe a stock has a particular price. That's the right price. As a interested party or a market expert, if we say it is not, the intrinsic value is higher or lower, there is some issues which will be there, so that it is not realizing its intrinsic value. And I'm not commenting on anything on specific, but what you are comparing is the last 10 years. Last 10 years have been real estate, residential real estate specifically, has been a brutal cycle. 2012 to 20 has been really tough cycle. We have not only seen consolidation happening with the developer. People keep looking at developer. You look at the entire value chain, which will have banks, which will have NBFCs, which will have brokers, which will have funds. Everybody has got consolidated. So this perception thing is sector related, and the sector was going through a massive challenge. So it reflected into NBFC valuation. It reflected into selective banks which were doing certain kind of lending. It also reflects into the funds. The number of fund participants have reduced by 80% in the last 12-14 years. So perception was towards the sector. Also, we'll have to be fair. The capital came in hordes when the FDI was opened in 2005. We couldn't do justice with that capital. So there was certain baggage that we were carrying, and then the cycle was tough. I would believe this time around, ever since the residential real estate cycle has turned from, say, opening of first lockdown and COVID, where the numbers are coming strong, and look at the developers and the way they are approaching the whole thing. It is absolutely delight to see that the large meaningful developers are not going about and raising prices abnormally. That was one of the concerns that I always used to feel. Developers have got matured that this business is about cash flow. Let's book the sale. Land is not something which drives value. So I see a lot of maturity coming overall in the sector. As far as your specific question on bias, I think as we perform as a sector, and it's not only developers, our funds also. If we haven't performed in last 8-10 years, those have got weeded out. So I think we need to give time, and we live up to the promise that we think next 10 years we can deliver. We will see a lot of value getting created across the life cycle.
Abhishek, if I ask you the same question from a different perspective, since you represent a company, how do you assess the intrinsic value of a real estate stock?
See, okay, so if I was to look at it as an analyst, and that's how I look at the business, I look at really three things currently, and this will evolve over a period of time. I look at the first thing that I look at is what is the kind of pre-sales number that he's doing, and what is the kind of volumes he can bring, and what geographies is the developer present in, and how do you put it in a risk return matrix. How is the diversification? Are there risks as far as geography is concerned? Is it one geography, multiple geography? What is the kind of price points you're looking at in terms of the developer's sales? Because is he really only focused on premium? Is he really focused only on mid income? Is he really focused on only plotted development, for example? So what is the product which the developer is bringing on the table, which markets? And then you understand that, okay, this is the kind of pre-sales he's doing today, and this is the potential of the universal set of the business. And pre-sales numbers are reflective of, the developer's capability to deliver a certain volume. That is point number one. As a developer, I'd evaluate. Point number two, I'd evaluate is, how is the cash flow looking? Selling is not enough. At the end of the day, I'm completely in agreement with Sharad that the business is completely changed in the way developers are looking at it. And of course, being listed and all of that helps in that sense, because it brings in equity, always brings in a lot of discipline. So if you look at cash flows and the strength of the cash flows, which means the operations are absolutely on track, which means cash flow comes in only when you construct and deliver on milestones, which means projects are getting completed or are in progress in a good way, right? So you look at the cash flows. And third, and not the least, you look at the debt. Now, when you look at debt, you look at what is the volume of business or value of business you're doing versus what is the debt you are sitting on. Not necessarily only the market cap versus debt. That is one matrix which I think is another whole story to look at. But what is very important to look at is that, okay, this is the kind of surplus the fellow is sitting on. This is the total potential of surplus that he's looking at. And this is the pre-sales he's doing and the cash flow. And then you relate that with the debt. So one of the matrices, for example, I kind of have come up with in my own head, and now we publish data as a company, is the debt per square foot of area under development. What does that mean? That basically means is that today, if your debt per square foot is say 3,000 rupees a square foot, and you stay with 3,000 rupees a square foot over next 3 years, your cost of interest over 3 years is 900 rupees at 10% average cost of capital. Now, if the same debt per square foot instead of 3,000 rupees becomes 2,000 or 1,000 rupees, that whole interest has gotten added to your bottom line, which means from 900 rupees, you have been able to bring it down. If you bring it down to say 1,000 rupees, it's then 300 rupees a square foot, which means 600 got added to your bottom line. So efficiency of capital is extremely important. Obviously, equity is far more expensive than debt, and there is a healthy balance that you need to maintain. And therefore, you should look at debt on area under development and the total potential of business and the overall business that you look at. So those are three matrices I typically follow when I evaluate any developer and look at then saying that, okay, this is the kind of land bank, this is the potential of the business, and then you discount, you make certain assumptions and discount. Basically, I think all the analysts who are today in the market have great understanding of the market, and the data is a lot more there. I mean, Sharad mentioned also, see, the other big problem earlier was that we didn't have enough market data, right? We didn't have enough data being published even by the developers, and the depth of disclosure was very low. With all of this, see, information is the key. If you have enough and more information and data, you can really slice, dice, analyze, and say, okay, this is where the valuation should kind of sit in.
Sharad, since you are funding to different developers, so I'm giving you a real life case study. Suppose there are two identical companies with the same kind of top line and bottom line, but their stock performance is way different. Then how do you differentiate between the two developers?
I don't do public market investing. Ours is more project specific exposures, city specific, project specific exposure. But I would, so it's a hypothetical question, it's difficult, but I'll just add on to what Abhishek is saying on how I would look to calculate the intrinsic value and in a real estate development company. Look, the way I look at it, there are two ways to do it. Simplest, easiest way is discounting of cash flows. That the developer, it's not a business, it's a business where you keep adding projects over a period of time. You can choose a period, like I would typically choose a period of 5 years. That would be my investment horizon. So I would see what are the potential cash flows going to come over a period of next 5 years. Discount those cash flows, get a value, give a terminal value for whatever is not getting developed at the end of the 5th year, add it to the NAV. And around that, then you start adding premiums. You start adding premiums like what kind of debt is he carrying? Which markets do they operate? So in my mind, if a developer is coming from, say, Calcutta, and a developer is coming from Bangalore developer definitely will carry a more premium. Is he a market leader or not? Brand recall. Then these are some of the fillers which starts coming in. This is one way. The second way is that you give a multiple of profit or multiple of sales. Everything is there in the market. The way I would look at it, that the first method is more scientific in nature, more predictable, and 5 years is a period which can be predicted in a given cycle. As far as markets are concerned, if the two developers are of similar size and scale, there could be various reasons. There could be various reasons, like I mentioned, about brand, which city they are operating, which asset classes. So if somebody is operating only in, say, low-cost housing, versus somebody who's operating in, say, luxury to mid, and the views around the market and how these two segments will do can also drive. Right? But the key is, how do you find the intrinsic value? I think markets have done really well. Real estate listed stocks have done really well over a period of last 2.5, 3 years. And I think a lot of them now, I would like to believe, are closer to their intrinsic value than lower than that.
Abhishek, that's a very interesting perspective. But Abhishek, tell me, do you agree that barring a few exceptions, most of the developers who are into luxury and super luxury, their stocks are doing far better than those who are doing affordable housing, even if the top line and bottom line is not very different?
Look, I think yes, and in a way, no. I'll just answer it. I'll try and explain what I'm saying. Now, see, one part is the fundamentals of a business, and which is the right and the most scientific way to calculate. But when you are in a listed space, and even in an economy, perception and emotion, there is a filter. That perception has got various matrices, and different businesses go through different cycles in their maturity as well. So, for example, and we all know, I mean, Warren Buffett, if you look at what he talks about value investing. What does he do really? He goes and identifies a business where there is enough value that has a potential to get created. Then he re-engineers the business to create that value, and hence the intrinsic value and the market cap goes up, and he makes his return. Similarly, different developers have different strategy, and therefore you will see different. So if you were in a value buying opportunity, I would go down the route of what Sharad is saying and saying, look, let me calculate what should be the scientific intrinsic value. Then look at what is the potential upside that I can gain given where the market cap is today, and look at their strategy. If you believe and if they perform and the track record of performance is consistent and it's showing a certain trend, and the direction of the management, which is the key in all, as Sharad rightly said today, I think professionalization of the sector has reached a certain stage of maturity. Availability of professionals in the sector also has changed. So if the management is strong and the strategy is strong, and if you add that filter, you look at the layer of the performance, and most importantly, the intrinsic value, and then you do the math, then I think you can work towards change of perception, and that over time creates a lot of value. And the key to that is really communication. So you have to see how that goes. Yeah.
Uh, See, data-driven analysis is something which is the foothold of industry stakeholders as well as analysts. But if you look a real estate stock purely from an investor standpoint, somebody is standing on the street who does not understand the nitty-gritty details of real estate business, what should he look into it?
See, Ravi, what you are saying is that, look, right now, the way the markets are, these are abnormal times. And in these kind of times, people end up making money, which is not purely on this skill. You get momentum and you end up making money. I would like to say that if I have to put my own money into a real estate development company which is listed, I will form a long-term view, which is 7 to 10 years kind. One. Second, because I fundamentally believe that the real estate as a sector will do exceedingly well, because we were down in the doldrums and we are coming out of an extremely low base, and an economic environment is getting better. We are extremely under-owned as a country. So 7 to 10 years of resi looks good. Then I would look for a market leader in a preferred city. So for me, the preferred city could be IT cities or Bombay. In these markets, I would look for a market leader. May not be the guy who's the leader, but who's in top 3, 5, and then I will look at that. Then I would look at what kind of sales that they have done over a period of last 2.5 years, and not go beyond 2.5 years. Before COVID 2020, everyone was struggling. So just look at last 2.5 years, how they have gone about their sales. There is a lot of euphoria, a lot of sales happening. Have they been able to capitalize on that? Then I would look at their senior management and the depth of that senior management. Then I look at financials. So it cannot be one word that, look, momentum play karna hai, you invest into this, everything goes up. That nobody knows. But if you form a big long-term view, I think real estate companies, development companies will do well. I am hoping at some point of time, real estate company, because real estate company gets valued like an infra company. एक project है, you discount the project. Every time you have to do a capex, you keep discounting it. I'm hoping at some point of time we reached where real estate development companies can get some bit of a consumer brand play. And then when the multiple will be very, very attractive. Till the time that happens, I think one needs to be a little cautious in euphoric markets to look at these as a budding thing.
Abhishek, what would be your advice for a layman, for a retail investor who wants to invest in real estate stock?
See, I think just two, three data points as I mentioned earlier. One is I completely agree. Look at the growth momentum of pre-sales numbers. If the growth momentum in last 2 years is above average and above the normal industry standard, and then you look at where the stock has moved. So one of the matrices which I think briefly Sharad mentioned is market cap versus pre-sales. Look at one of those matrices, and that's a very simple matrix to follow. It's not a very difficult matrix to follow. If you just look at one matrix and you look at the cash flow, I think these two I would look at. But what I found Sharad saying very interesting, and I want to delve on it a little more. When he says 7 to 10 years, the reason for that is the power of compounding. See, when you look at and the speed at which you are capturing the power of compounding, market is clearly consolidating, and we are only at 33-35% of the market consolidation. In my opinion, we will go to 70% of market consolidation over next 10 years time frame. If you're on that journey, then irrespective of what is happening in the market, some of these guys are definitely going to make and gain market share. Who takes away how much market share? You calculate by how much his pre-sales numbers are growing, at what rate, at what percentage it is growing. And then you obviously look at their acquisitions, and eventually it'll get into the EBITDA numbers, etc. So the power of compounding is going to be the key differentiator. And in a market which is growing, I'm even assuming there'll be a cycle in next 10 years, minimum a cycle. Hopefully, we don't know. We are saying we are in a long bull cycle. It could be there is no cycle at all, but we don't know what happens in the world, and you could have a brief cycle for that matter. But having said that, if you look at the consolidation piece in the country, I think some of the developers will be disproportionate. So you need to track that disproportionate capture of markets.
Sharad, what actually and why I am asking this question is that in the past, a lot of retail investors have burned their fingers. Some of the large real estate companies with higher valuation, and their stocks today are nowhere around. So, from a retail investor standpoint, I am looking at a developer who is large, listed, everything is going right. And suddenly in the next 2 quarters, it has gone bust. So how can a retail investor safeguard in this kind of atmosphere?
Ravi, one thing we have to be mindful here is that real estate listing probably started around 2005-06 when we saw meaningful listing. It's been 16-17 years. The challenges that the sector has faced, it's not only the retail investor participating in some of these listed companies from 2006 till 2020 have suffered. The entire sector went through a big churn. So it's a sector issue rather than specific developer. Of course, within those developers, there were certain developers who were not managed well. They were not financially disciplined. You had those kind of collateral damages. I would like to believe the sector is actually in last, and I'm in this business for last 20 to 23 years. I see significant improvement. The approach of large developers, the way they are approaching the business is very different than what it was 15-17 years back. So I would say people will have to, people are buying houses also. Investing into a stock is an investment. You are taking up bet with your money. Here, people are taking bet with their entire life earning to buy a house with the same guy who's making it. So I think trust is coming back. People know that the sector has got regulated. It will reflect into everything, whether it is the discipline around delivery of apartments or value creation in the equity markets. We'll have to give it time. It's been only 2 years. In that also, there is a lot of value being created. I don't foresee a situation wherein you have companies falling off the cliff. Those kind of companies, I would say, are not there or will get listed. Markets have matured. Investors are smart now. They have learned from what has happened in the past. So I don't think so we would have falling off the cliff kind of a situations, companies going bankrupt, and see the whole cycle from a largest real estate value company to completely eroded or bankrupt in like 2 years time. I don't see those kind of situations.
Consolidation cycle is complete. Abhishek, do you think consolidation cycle is complete now, or there are risk elements still there in the business?
I think consolidation cycle is kind of, the number of players left is obviously very limited now in terms of structured, branded, organized players. Now, when I'm saying consolidation, I mean is that the how much market share these guys will take away. So some people who are mid and small, they will still get consolidated. They will change their role and possibly become landowners, land partners, sourcing of land. So there is some change in the value chain and the role play that will happen of the balance people who are today in the business. There'll obviously be some local, strong, very good developers, etc., that will continue and they will continue to, but they are in a certain limited space and have a certain limited potential, and they will continue to be strong players in their markets. Having said that, I think consolidation is a journey which is still there. One or two of the guys may make a mistake, and one needs to be mindful of those mistakes. But I want to add one more filter here: the quality of management, promoter, reputation of the promoter, and most importantly, which kind of institutions are investing in that developer. The quality of shareholding and the quality of capital providers is extremely important for you to understand whether there is going to be, if there are international capital providers who are partnering, which means the developer is able to attract institutional international capital. They are partnering, not just uh, uh, buying off their assets or things like that. If there is a partnership that is there, I think then your confidence level could go much higher, because you know that they are transparent in the practice of what they are saying. So, I think those are some of the filters I would add.
We are running short of time. So my final question is, uh, I have spoken to a number of analysts on this subject, and some of them, or should I say many of them, have suggested that for a retail investor, it's better to get into the proxies into cement, steel, instead of getting directly into real estate stocks. I know this will make you very uncomfortable because you represent a real estate company, but how do you look at this analysis?
Look, as a personal portfolio, now let me look at myself as a individual. My exposure to real estate is, of course, in my own house, in my real estate investments. But as far as stock markets is concerned, I have a balanced portfolio. When I say I have a balanced portfolio, I'm looking at making some kind of a investment in a particular value chain, which in any sector. So there are certain core sectors which support all the sectors, right? So those are some investments that I definitely look at. There are certain type of technology stocks which I definitely look at because they are safety stocks. But if I look at only the real estate space, I would diversify my investment between the value chain and the developers, because I think ultimately developers are the leading indicators of what is going to happen with the rest of the value chain. If the development business is doing well and you are seeing strong pre-sales, then in the value chain also you will see substantially strong. So if you remember and you look at what's happened to the stock, Sharad was talking about last 15 years, 20 years. After 2008, while the real estate developers were suffering, the rest of the value chain has also suffered. There has been gain in the core sectors and the sectors servicing the real estate industry as the real estate industry has improved. So real estate becomes a leading indicator. You look at that, and then you look at the rest of the value chain, and then you find those investment opportunities. So I would look at the whole chain and then diversify my investment.
Sharad, what would be your advice?
Look, like I agree with Abhishek on the you need to have a diversified view. But to say that the proxies to real estate will do very well and the real estate company, which is some part of all of them, will not do well, it's contradictory. The challenge here is that some of these companies which are proxy are large, have a large track record. They're large corporates, so they draw more comfort and trust. Wherein our real estate companies, history, listed companies, universe have a very checkered background, and I think it's about trusting part of between the two variable. I think over a period of time, from over a period of next 5, 7, 10 years, there will be emergence of very credible listed real estate developers, which are institutionally owned, also professionally run. Of course, there will be a sponsor who would be doing it, but I would say when that happens, there will be a lot of keenness to also play through real estate development companies. But fundamentally, if proxy has to do really well, the some part of it is developer that will do well.
Well, that has really been a very interesting discussion. I hope many of the investors, and when I say investors, I mean retail investors, who are always clueless when it comes to real estate stocks, they can get some clarity with our discussion today. Thank you, both of you. We will look forward to having more such discussions in future. Thank you.
Thank you,
Thank you,
Ravi.
Ravi. Thank you,
Thank you,
Abhishek.
Sharad.
Thank you.
Thank you. Pleasure. Pleasure.